It's Brian Preston, the money guy.
All right. We've got a question from Miles Smith on YouTube. He says, I'm 26 and aggressively doing debt avalanche on my highest student loans. Once done, should I increase pre-tax and Roth contributions or focus on finishing the lower interest student loan debt?
So what's great is we have a resource that will answer that question for you. I mean, I'm going to give you the answer because I'm a super nice guy, but we have a resource. If you go to the website, moneyguy.com/resources, and go look at our financial order of operations, you can walk through step 1, 2, 3, 4, all the way down to 9. Well, if you have low interest student debt, I would argue that that falls in step 9, prepaying low interest debt. You know, high interest debt is step 3, so knock those out, obviously. But if you have low interest debt, I would argue that it probably makes a lot of sense to begin working through steps 4, 5, 6, 7, 8, and then coming back to step 9. So a lot of folks say, well, I don't know how to qualify that. How do I quantify with student loans?
What qualifies
what's
as
low,
low?
what's high?
Yeah.
We think you have to be a little intellectual on that, but don't worry. We've done a lot of the thinking for you, so we can kind of break it down. We look at the equity risk premium. All that means is the amount of return that you receive for taking risk. I can put, this is rudimentary and not exact, so don't correct me. I know that this isn't perfect for all of you that understand what I'm saying here. But I can put money in CDs and make a risk-free rate, right? Or I can invest that dollars, and whatever I make above whatever that risk-free rate is called my equity risk premium. Well, as we age, our equity risk premium should theoretically decrease, right? So we take on less risk, we get more conservative, so the rate of return should come down. Makes plenty of sense, right? So here's sort of our rule of thumb based on historical equity risk premiums. If you are someone in your 20s and your student loan debt is below 6%, we would argue that qualifies as likely low interest student loan debt. So you should probably prioritize building your army of dollar bills. Now, once you get into your 30s, we think it decreases to 5%. So if your student loan debt is below 5%, that counts as low interest in your 30s. In your 40s, it drops down to 4%. And then in your 50s, we like you to not have any student loan debt at all. Unless you're acquiring it for your kids, then that's sort of a different thing. So we would prioritize it based on your age. And if you are in some of those lower interest loans, 2s, 3s, 4%, I think that you can do a lot of damage in a good way by building your army of dollar bills elsewhere.